Welcome back into Thimbleberry U. I am John Jagay, joined by Amy Wallace from Thimbleberry Financial. Good to be back with you, Amy.
Jag, it's fun to be here.
So we're talking today about something that has come up in the news a lot and is a really important thing to think about as we look forward, and that is tax-efficient investing, especially in a brokerage account. Let's start at the top. What is tax-efficient investing?
Tax-efficient investing is investing in a manner that focuses on minimizing taxes.
Okay.
Now, it doesn't negate the need for investment selection or asset allocation. Those are still a vital part of a tax-efficient investment strategy, just like any investment strategy. To have tax-efficient investing make sense, we need to revisit the ways money can be saved.
Okay.
And we talked about this in the very first podcast. There's really three ways people can save money. The first is in before-tax accounts. These are things like IRAs and 401ks and 403bs. When you pull the money out, it comes out as if you just earned the money on a paycheck.
You're paying the taxes when you withdraw it, not when you save it.
Yep. And the way I describe that area is as long as the money is in an account, it's like you standing under an umbrella. You're not getting hit with the tax raindrops.
Yes.
The money isn't getting hit with the tax raindrops. Second corner of the triangle is after-tax dollars that aren't inside any type of retirement account. So this is a brokerage account. It's individual stock. And so this is the area that I'm focusing on today. Here, you had an umbrella, but the umbrella blew away, so the taxes are just coming down. And since we're going through this, I'll just touch on the third area, which is also after-tax investing. But that money comes back to you tax-free, things like Roths.
Got it.
Okay. So here in the second taxable area where the umbrella is blown away, these dollars are partially taxed. It depends on how long you've held them.
Okay.
So if you have held these investments less than 1 year and you sell them, they are taxed at ordinary income rates. This is just your tax bracket that, we're used to talking about. If you have held them more than a year, they are taxed at long-term capital gains rates, which can be 0, 15, or 20%. Which it is for you depends on your ordinary income tax bracket.
Got it. Okay. So when does someone need to pay attention to these taxes?
Always. No, it's really why my very first podcast was on the 3 ways to save and the tax consequences. The long-term effects is an area that's often overlooked by investment advisors as they build portfolios and CPAs. And there are 2 things that always matter in investing. One is fees. That's not today's topic, but I'd remiss not to include it in what I'm about to say.
Yep.
And the after-tax rate of return on the account.
Okay.
The net after-tax rate of return also is after fees, and that's the return that matters. Too often we just say, oh, here's a rate of return. But if we're talking about investing in this area where the umbrella blew away, we have to take those taxes out, and we should talk about that after fees.
Right. Taxes and fees come out, and now the money that's yours at the end is going to be what's yours after the taxes and after the fees.
Correct. The other thing that's really important here to note is that when you're paying taxes on these kinds of investments, it's generally paid from cash flow and not the investment. So unlike if you took money out of an IRA, individual retirement account, where you can have taxes withheld, these dollars, there's no way to have your taxes withheld. So you either have cash flow, or cash reserves that are going to have to pay this, or you're going to have to sell more investments in order to pay this bill, and then you're just on a slippery slope.
That is a really important point, that the taxes are not coming out of that investment. That's got to come from somewhere else.
Yes.
All right, so how much can tax-efficient investing add up, Amy?
Jag, this is such a great question. So consider this. As a whole, U.S. equity funds, which includes active, passive, and ETFs or exchange-traded funds, as a whole, gave up 2% of returns to taxes for the 5 years ending in December 2020. So that's January 1st, 2016 through December 31st, 2020. And that information is according to Morningstar.
Okay.
So with that said, if you had $1 million invested in this area, your tax bill annually would have been approximately $20,000.
Yikes.
Okay. And $5 million is $100,000.
So again, as we said a moment ago, that $20,000 or that $100,000, depending on the example, that's not coming out of the investments. That's going to come from somewhere else.
Absolutely. So you have to be prepared that these dollars add up. And I find it's a huge surprise for people that are getting a windfall, whether that is a big inheritance and they're looking at how that's going to change their life, or maybe an IPO or something to that effect. Going back to this tax-efficient investing and how much it adds up, for those same 5 years, so January 1, 2016 to December 31st, 2020, U.S. equities had what's called tax drag of 1.7% on average. International equities, international stocks, had tax drag of 1%. And fixed income, this is bonds, had tax drag of 1.4%. You know, someone might say, wow, that 2% seems high. But U.S. equities on their own were 1.7%. Okay, so that's not 2%. It's a little bit less. But I think those are important numbers. Like, I think there's a question of where does this 2% come from? But if we just look at U.S. equities as a whole, 1.7%. And all of those numbers came from Russell Investments.
Got it.
So let's do some math on this. And I'm going to use Russell investment portfolios here as I can compare across two concrete portfolios for the time.
Okay.
I used Morningstar to run some hypotheticals on this. So if at the beginning of those 5 years, you invested $5 million into Russell's tax managed balance portfolio, and let's say you invested another $5 million into Russell's core balance portfolio, both of those portfolios are moderate in terms of risk. In the tax managed portfolio, over 5 years, you would have paid $172,715 in taxes. That's much less than the 2% we were talking about.
Ah, got it. Okay.
The core portfolio would have cost you over $534,000 in taxes.
I'm just doing some quick math in my head, and that is ballpark 3 times the other portfolio.
Yeah, roughly. So it definitely adds up, and that's why we have to pay attention to the taxes whenever you're investing in a brokerage account.
So managing those taxes, so important. Those numbers bear it out. How do we do this?
There's different ways. One could be a portfolio of stocks. You can use mutual funds, index funds, ETFs, exchange-traded funds. And these can be self-directed or through a managed portfolio created by an advisor or a third-party money manager, such as the Russell portfolios I just talked about. Another way would be municipal bonds.
All right, so stocks, mutual funds, index funds, ETFs, municipal bonds. What are some of the pitfalls on these strategies?
The first one is surprise tax bills when you're using mutual funds, index funds, and ETFs. Now, ETFs tend to have less surprise tax bills than mutual funds and index funds. What happens here is inside of a fund, there's trading that happens.
Sure.
As the money manager is buying and selling stocks. Well, some of those they're going to lose money on, and some of them they're going to do well on. Ultimately, those get put together to say, is there a loss or is there a gain overall? And when there's a gain, they have to pass those back to investors. So a lot of times people will look at index funds and say, hey, this is a great place to invest. It's really low cost. Well, over the last number of years, there have been equity funds, index funds, that have returned 9%, 11%, 16% back of the portfolio back to their investors in the forms of capital gains. And this tends to happen in December. So it's a big surprise tax bill. ETFs don't have to pass back those gains. However, when they have gains that result from currency exchanges, really with international investing, they do have to pass those on. So it can still happen. Now, the second pitfall is rebalancing.
Okay.
And this is where a do-it-yourselfer can run into problems.
Okay, yeah.
So, Jag, rebalancing is returning your portfolio to the ideal mix.
Yeah.
So let's say here that your portfolio only needs 2 investments, and they're both going to be diversified. Okay. So we'll take that question out. But you need 50% of investment A and 50% of investment B.
Mm-hmm.
Well, time goes by and investment A is now 75% of the portfolio and investment B is 25% of the portfolio.
Right.
Which investment do you want to keep more of?
You almost tripped me up there because I'm thinking about it like my gut says I want more of what's worth more, right?
Uh-huh. Absolutely.
Then that's what I would do if I was a DIY investor.
Absolutely.
And this is where you come in to save the day.
I love it. I feel like Mighty Mouse right now. Yeah, exactly. That's what most people would tend to do. They'd say, well, I want more of A. I definitely don't want less of A.
Right.
But to get back into balance, we need to sell enough A and put it back into B to bring us back to the 50-50 mix.
Diversification, protecting yourself.
We have to make sure that B is still a good investment.
Yeah.
If it's a bad investment, we need a new version of investment B. But that's rebalancing. And general behavior says, oh, whoa, no, I want to keep more of A. And so you have to recognize the need to get back to that. And then the piece we haven't touched on is to sell A. You're now going to have a tax bill for having sold A to buy B because A was at a gain.
Ah, got it. See, this is why I like talking to you, Amy. You break these things down and explain them in terms that even I can understand.
People want to avoid that tax bill. They think it's not worthwhile, right, to incur this bill. But in reality, it's what keeps them safe going forward and gets them a steady, consistent climb towards their goal.
A friend of mine gave me a great piece of advice when it came to taxes and investing once, and that is that people, to your point, want to avoid paying taxes. Oh, I don't want to pay taxes. But in some cases, if you're paying more taxes, that means you're making more money. Like, you wouldn't say, no, I don't want to win the Powerball because the taxes are going to be too high. So avoiding taxes and being smart about your taxes is one thing, but you don't want to have this exaggerated approach of, I want to avoid all taxes at the cost of actually making some money.
Absolutely. And I do understand it because when you look at, let's say you're selling A and that's going to be a $30,000 tax bill.
Right.
That might be high. It might not be. All of a sudden you're looking at that and saying, well, that comes out of my cash reserves, or I don't invest all of it back into B. How am I going to fund this bill? That means these fun things that I had planned I might not be doing.
I mean, $30,000 is a car.
Exactly. So you had originally asked, though, about pitfalls. Another one is the emotions and the bias. People get attached to their stocks and their holdings.
Yeah.
Especially when they're doing well.
If they're doing well, or if it's a company that you personally really believe in, that can really come into it. Oh, yeah, they're kind of down. It might be, or they're up and it's time to sell, buy low, sell high. But yeah, I really like this company. I think it might go higher. I know the smart thing would be to sell right now, but I just like saying I have stock in X.
Yeah, that's how people think about it. And it's okay to have some of that money. What we have to do is make sure that someone's safe in the amount that they have and that it fits with their longer term goals.
And this, as we feel like we mentioned every time we sit down and talk, Amy, this is where you come in because you're looking at somebody's money objectively as opposed to them looking at their own money and investments subjectively. So I think that is so important. Anything else to touch on before we wrap up?
Yes, there's one thing that we didn't talk about in here, and I think it ties the conversation we were just having with rebalancing and incurring taxes when you don't want to. Mm-hmm. And that is future tax uncertainty. And I'm not getting into politics here. We don't know what tax rates will look like in the future.
Right.
We know we're running at a deficit. We know the government either needs to cut expenses drastically or they have to increase taxes. One of the two.
When you're at a deficit, you have to increase the money going in or decrease the money going out. And again, not getting political, but we just spent a few $1 trillion for coronavirus relief.
Absolutely. So there's a question out there as to what these tax rates will look like in the future. Will we even have capital gains rates, or will they become ordinary income tax? So if someone is on the fence about, should I rebalance? Should I realize some of these gains? And should I be investing in a tax efficient manner? It's part of what has to be considered. And I would say, yes, you do need to be looking at at how to invest tax efficiently so you can keep more of your money. And hopefully, if tax rates do change in the future, you're not going to be hurt even more with an unexpected bill.
All right, so Amy, if somebody wants to come talk to you at Thimbleberry about these tax strategies, about having that unemotional look at their money and their portfolios and their investments, and also to keep track of what's happening tax-wise going forward and staying on top of that stuff, what are the best ways to find you?
They can find us online at thimbleberryfinancial.com or by giving us a call at 503-610-6510.
Good stuff as always, Amy. We'll talk again soon.
Sounds great, Jag.
Registered representative, securities offered through Cambridge Investment Research, Inc., a broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated.